Welcome to the Deep Dive. We're here to give you that intellectual shortcut, cutting through the noise on the world's most important systems. Today, we're tackling something pretty central to India's story, the Nifty 50 index. We're going back a full quarter century. If you really want to get a feel for the Indian economy, one of the fastest growing out there, this index. This is basically the pulse.
It really is, yeah. Think of the Nifty 50 as, the essential starting point for understanding India's stock market. It's basically a weighted average, right? 50 of the biggest, most liquid stocks trading on the National Stock Exchange, the NSE, and the name. Super simple, just National Stock Exchange plus 50, Nifty 50. It's meant to be straightforward.
Right. And our goal today, our mission for this deep dive, is to get past just the ticker symbol flashing on a screen.
Yeah.
We want to unpack its journey, how it's changed structurally, the methodology behind it, which is actually more interesting than it sounds, believe me, and really explore why its 25-year history makes it the key indicator of India's economic transformation, from emerging market to, well, global player.
Absolutely. And here's a great little fact to kick things off. The index officially launched back on November 3rd, 1995. Now, just think about everything India's gone through since then: technology, the economy, politics, massive shifts. But despite all that churn, there are 12 companies, believe it or not, that have been in the Nifty 50 continuously since day one.
12. Wow. That's actually incredible stability, isn't it? In that kind of high-growth environment.
It's pretty remarkable, yeah.
Okay, so let's get into it, starting with the basics, the blueprint, if you will. Any big index like this needs a few core things, right? Diversification, liquidity, and replicability. And you're saying for the Nifty 50, that last one, replicability, that's really key.
It's crucial. Replicability just means that things like ETFs or index funds can easily copy the index's performance, without their own buying and selling messing up the prices of the stocks in the index. Which brings us to how it's calculated, the methodology. And there was a really important change here. Originally, way back, they used a company's full market capitalization.
Okay, hang on. Full market cap means counting every single share, right? Even the big chunks held by, say, the government or the founding family that never actually get traded.
Exactly. And that was the problem. It kind of distorted things because companies with huge but inactive promoter stakes could end up dominating the index weightings, maybe artificially so. So starting June 2009, they made the switch, a big one, to the free float methodology. This means they only count the shares that are actually out there, available for public trading. It filters out those locked-up blocks held by insiders or governments. It gives you a much, much truer picture of the capital that's actually active in the market.
That makes total sense. You're measuring what's really moving, not just the theoretical total value. Okay, so if a company wants to join this exclusive club, what's the criteria? The sources talk about pretty strict rules, especially around liquidity, something called impact cost.
Yeah, impact cost is basically the gatekeeper. It's a measure of how much the price moves when you try to buy or sell a large chunk of stock. The rule is the stock has to be super liquid. Specifically, its average impact cost needs to be 0.50% or less, most of the time, like 90% of observations for a standard trade size of 10 crore rupees.
Impact cost.
Yeah.
It sounds technical. Can you break that down? Like practically, why is that 0.5% target so important if I'm running an index fund?
Okay, think of it like this. If you, as a fund manager, need to buy 10 crores worth of stock X because it's in the index, the rules are saying that big purchase shouldn't really budge the stock's price by more than 0.5%. It means there's tons of buyers and sellers. The stock is really deep, really liquid. It stops the big index funds themselves from, pushing the price around wildly just by doing their job of tracking the index. It keeps things stable and makes sure the index reflects genuine market sentiment, not just a few huge trades.
Ah, okay. That's a really clear way to put it. So deep liquidity is paramount. And to keep things current, it's not static. Companies also need to have derivatives, futures, and options traded on the NSE, right? Shows there's broad trading interest. And the index gets rejigged twice a year. End of January, end of July.
That's right, semi-annually. And just look at the scale this thing captures now. Back at the start, the Nifty 50 companies represented about, 33.7% of India's total market cap. By late 2021, that number had jumped to 53.2%. Over half the entire Indian stock market value captured in just these 50 names.
Wow. Yeah, that really underlines its role as the national economic barometer. Okay, so the blueprint is solid, designed for stability and accuracy. But how has that structure dealt with the massive economic shifts happening underneath? Let's get into the evolution now, because tracking how the sector weights have changed over 25 years, it's like uncovering a hidden history of India's economy.
It really is, yeah. It's a dynamic picture. The most striking shift, financial services. It started around 20% back in 95. By late 2021, it had absolutely surged, became the biggest sector by far, 37% of the index weight with 11 different companies. And this isn't just banks getting bigger, it signals something broader, the formalization of the economy,
Yeah.
credit moving into the structured banking system, fueling growth.
And then there's a story that really screams modern India, the IT sector. Back in 1995, it wasn't even there. Zero weight.
Exactly, nothing. That reflects India before liberalization really kicked in, before the whole outsourcing boom. Fast forward to late 2021, and IT makes up almost 17.9% of the index. It's a massive climb, showing India's pivot towards becoming a knowledge-based, service-driven economy on the global stage. It really leveraged its strengths there.
And the flip side of that is the traditional sectors, the old guard. They've seen their influence shrink quite a bit, relatively speaking.
They have. Consumer goods, for instance. Used to be a heavyweight at 19% in 95. By late 2021, down to about 10.8%. Same story for metals. Dropped from almost 11% down to just 3.4%. Now, it doesn't necessarily mean those companies are doing badly, but the sheer growth rate of finance and tech has just been explosive, reshaping the whole index.
But even with that diversification across sectors, there's still a pretty stark concentration, isn't there? The figures show the top 10 stocks make up, nearly 60% of the weight, 58.3%. Does that mean the Nifty 50 sometimes behaves more like a Nifty 10? How risky is relying so heavily on just a few giants?
Yeah, that concentration. It's always a talking point. But it's also kind of the reality of an emerging market that's developing fast. You have a few truly massive corporations that have reached global scale, and the index has to reflect their dominance to be accurate. You see it most clearly with the biggest one, Reliance Industries, holding over 10% weight just by itself. So yes, there's some single stock risk exposure there, but it also means the index is anchored by these really resilient, high quality, often high governance companies that tend to pull the whole market along.
Okay. And before we move off this, let's just acknowledge those anchors properly. The enduring dozen, as you called them. These are the 12 firms that have stayed in the index right from the very beginning in 1995. Maybe group them so we can grasp who these long-term survivors are.
Sure. You can think of them in maybe three main buckets. First, the core banking and finance players, HDFC Bank, HDFC Ltd, ICICI Bank, and State Bank of India.
The bedrock, really.
Okay, the financial core. Then you've got the heavy industry and manufacturing backbone. Tata Motors, Tata Steel, Hindalco, Larsen & Toubro, and Bajaj Auto, the builders and makers.
Got it. Industry giants.
And finally, the big conglomerates and consumer staples that everyone interacts with. Reliance Industries, Hindustan Unilever, and ITC.
Right. Staples and conglomerates.
Exactly. And that list, it really tells a story. The index is dynamic. You see companies coming and going every year, about 4 changes on average. But the underlying stability, the long-term performance, it really does rely on this surprisingly small group of incredibly resilient market leaders.
Fascinating stuff. Okay, let's shift gears to performance now, segment 3. Because at the end of the day, people want to know about returns. And when we talk about how much money an investor actually makes over time, we really need to stress the importance of the total return index, the TRI. Why is that the only real metric to use?
Right, because the basic price index, the one you usually see flashing on the news, it misses a huge piece of the puzzle, dividends. The total return index, or TRI, assumes you take all the dividends paid out by the companies in the index and reinvest them straight back in. Over many years, that compounding effect makes a massive difference. It boosts the total return way beyond just the price changes. Dividends are absolutely key for long-term wealth here.
And looking at those TRI numbers, they're really quite compelling. The data up to late 2021 shows that since mid-1999, the Nifty 50 TRI delivered annualized returns of 14.9%. That's CAGR, compound annual growth rate. Even with the bumps along the way, annualized volatility around 22.9%.
And it's that consistency over time that's really striking. If you look at rolling returns, meaning performance over fixed periods like 7 or 10 years, but starting at different points in time, well, over those longer horizons, 7 years, 10 years, the chance of actually using money approached 0. The frequency of positive returns is almost 100%. So if you held on for a decade in something tracking the Nifty 50, you were pretty much guaranteed to come out ahead.
And not just ahead, but often significantly so. Over a 10-year holding period, the index delivered more than 15% per year, almost half the time, 47.9% of recorded instances. That really highlights its power as a wealth compounding engine over the long haul.
But yeah, that volatility figure, 22.9%, that's real. It's definitely part of the experience. We can't just talk about the gains without acknowledging the really rough days. I mean, remember March 23, 2020, peak COVID panic. The index absolutely cratered, lost nearly 13% in a single day, the biggest fall ever recorded. Just pure panic selling.
Oof, yeah, that was brutal. And you also had the ripple effects from the U.S. subprime crisis January 21, 2008, an 8.7% drop. Big hits.
Definitely. But then you also get these bursts of euphoria on the upside.
Right, like the biggest single-day gain ever,
Mm-hmm.
a staggering 17.74% jump on May 18, 2009. That was following decisive election results, a huge wave of optimism.
Exactly. So that constant swing, that drama, it really underscores the long-term trend. You get these sharp shocks, but the underlying trajectory has been strongly upward.
Okay, finally, let's touch on the Nifty ecosystem. For most of you listening, you can't just buy the index itself. So how do investors actually get exposure to this benchmark?
The main ways are through index funds and exchange-traded funds, ETFs. Simple products designed to just mirror the index performance. And in India, this is a massive market now. The Nifty 50 is the go-to benchmark for equity ETFs. It accounts for over half, 52% of all the money in equity ETFs. That was over 163,000 crore rupees back in late 2021. Huge sums tracking this index.
And it's not just an Indian phenomenon, right? The Nifty 50 has a real global presence now.
Oh, absolutely. You've got Nifty 50 derivatives, futures, and options trading not just on the NSE in India, but also on the NSE's International Exchange in Gift City, and crucially on the Singapore Stock Exchange, SGX. That's a key hub. Plus, there are international ETFs listed in other countries that are based purely on the Nifty 50. Last count, there were 7 of them, holding over $1 billion in assets. It's definitely used as a proxy for investing in India globally.
Okay, so the classic question then, Nifty versus Sensex. We hear them mentioned together all the time, often feels like a rivalry. What's the actual difference, fundamentally?
Well, the basics are simple. Nifty is on the National Stock Exchange, NSE, tracks 50 stocks. Sensex is on the older Bombay Stock Exchange, BSE, tracks 30 stocks. I guess, philosophically, the Nifty 50, with more stocks, aims for a slightly broader representation of the market, covering more sectors and ensuring that high liquidity we talked about. Sensex, with 30, might be seen as slightly more concentrated on the very largest, most established blue chips. But Nifty arguably captures more of the market's overall dynamic.
And the Nifty 50 isn't alone, it's just the flagship, right?
Yeah.
NSE Indices actually manages a whole suite of related indices.
Exactly. It's a whole family. You've got the Nifty Next 50, basically the 50 companies knocking on the door of the main index. Very popular. Then there are sector-specific ones like Nifty Bank, Nifty IT, and even strategy indices, things like the Nifty Y Low Volatility 50 for investors looking to manage risk in a specific way. Lots of tools there.
What an incredible journey. It really shows how a single index can encapsulate so much about a nation's economic story. So to wrap up, the Nifty 50 really stands out as that definitive, reliable yardstick for India's economic health. Its smart methodology using free float, focusing on that impact cost for liquidity, makes it a stable, investable proxy for India's leading companies. And that solid foundation is why it's managed to deliver such strong wealth-building returns over the long term.
Yeah, and maybe the final thought links back to that tension between change and stability we discussed. The fact that only those 12 companies have lasted the entire 25-plus years, despite constant turnover in the Index 101 companies have come and gone in total, it really highlights something. It shows that while the market is always evolving, the core strength, the real anchor of performance and stability, often rests with just a handful of these truly dominant long-term players.
Which leads us to a final question for you, the listener, to think about. In a fast-changing economy like India's, what does that concentration tell you about where true, lasting value often lies? Maybe it's less about chasing every new trend and more about understanding and trusting those enduring anchors, something to consider for your own long-term view.
अगर आपको वीडियो पसंद आया हो तो लाइक, शेयर और सब्सक्राइब जरूर करें।